Greetings again. Today we're continuing our lesson in Principles of Accounts, specifically focusing on non-trading concerns. Are you ready to learn more? Let's get started. In this lesson, we'll be covering a number of concepts, including the Statement of Affairs, Receipts and Payment Account, Subscription Received Account, Bar Trading Account, Income and Expenditure Account, and Balance Sheet. The first concept we'll be learning about is the Statement of Affairs. Imagine you're organizing items in your home with a view of determining their net worth. You list in categories all the things that you or your family own and write down their values. Of course, you may come across some things that you may still be owing for. You also list those items and their values. Well, a statement of affairs is just like that, but for an organization. It's an accounting record that lists all the assets, like building or equipment, and their liabilities, like debt or loan. It helps them see their financial position and how much they own versus how much they owe. Now, let's use the information provided to prepare our first statement of affairs. Now, the statement of affairs makes use of all opening balances on an organization's books, dividing them into assets and liabilities. You may think of it as a renamed balance sheet or a statement that makes use of the accounting equation to determine the organization's accumulated fund. Now, speaking of opening balances, these are the balances from the 1st of June 2005 based on this question, along with the opening balance in the receipt and payment account. Now, it is important to note that this opening balance isn't normally included along with the other balance where they are placed, but instead it is placed separately. So always ensure you make use of all those balances given. Now, the next task is simply to divide those items into assets and liabilities. Of course, the receipts and payment account balance, because it's on the debit side, it will be considered an asset. Subscription in arrears, meaning monies owed by members as part of the membership fee, that's also an asset, similar to debtors or accounts receivable. Bar stock, that is also an asset. And the valuation of theater equipment, normally a non-current asset, altogether $78,280. All right, let's list the liabilities quickly. There are three liabilities, namely subscription in advance, meaning fees that the members would have paid for a period yet to come. Owing to bar suppliers, the same as creditors or accounts payable, and production expenses owing. All right, that's a total of $7,900 for the liabilities. And deducting that from the total of the assets give us a total of $70,380. Now, this figure is normally referred to as capital if we're dealing with a trading organization, a normal business. However, because it's a non-trading organization, a not-for-profit organization, we call this accumulated fund. Now, the next bit of accounting record we would consider is the receipts and payment account. Now, this account typically is used to record all receipts of cash and checks and all payments by cash and check. Sound familiar? Of course, you would have dealt with a cash book before, or a cash account, or a bank account. It is no different. You must remember, of course, that only cash and bank transactions or bank items will be recorded. In other words, non-cash items like, for example, bad debts, depreciation, would not be placed here. And of course, they would not be placed in a typical cash or bank account. Now, in this question, the items were already placed on the correct sides, and you simply have to find the closing balance. So what would be done is to total the debit side and subtract the total of the credit side and find the difference. Okay. Now, of course, that is how I chose to proceed because I already knew the balance. Of course, what you could have done was simply to find the sum of the debit find the sum of the credit, well, of course, without the balance, and then subtract both of them. And there you have it. In short, all money generated by an organization is recorded on the debit or receipt side, while all spending is recorded on the credit side of this account. Now, additionally, adjustments are usually made to items in the receipts and payment account to determine the amount to be transferred to the organization's main income statement. In this case, it's called an income and expenditure account. Using our example, members' subscription and production expenses are the two items that would be adjusted based on the additional information provided in the question. Now let's dive into preparing a subscription account. This is going to be fun, I promise. Imagine you have a special book where you track all the money you receive from your friends who become club members. This book is called the subscription account. Let's see how we can prepare it step by step. Now, because of members' underpayment or overpayment of subscription, this account is prepared to calculate the full amount due and belonging to the current period or year. This figure, when calculated, is transferred to the income and expenditure account as the main income of a non-trading organization. Now, the amount to be transferred to the income and expenditure account can be calculated by simply multiplying the subscription per member by the total number of members in the given organization or club. When total membership and fees per member are known, then difference between this calculation and the figure shown for subscription in the receipts and payment account is either due to owing or prepayment. Now let's proceed because oftentimes the number of members isn't given or isn't known. Now the subscription account is a revenue account. So the owing brought down or brought forward would be on the debit side, whereas the prepaid brought forward would be on the credit side. The receipts and payment figure would be on the credit side simply because of double entry. In the receipts and payment account, subscription appear on the debit side. So of course, in this account, it would be on the opposite side. Okay. Based on the information given in this question, when brought forward, our subscription in arrears at the start of the year was $700, and at the end of the current year, that figure rose to $920. On the other hand, prepayments at the start of the year was $320. However, that figure decreased to $120. Now, the total of the subscription in respect of the current year can be calculated simply by deducting the total debit from the total credit, which is equal to 10,160 minus 820. That gives us $9,340 recorded as income and expenditure, meaning this figure will be transferred to the income and expenditure account. Now let's quickly recap the steps that we followed in preparing the subscription account. Firstly, we start with the receipts and payment account and identify the member's subscription in that account. Secondly, we need to figure out the subscription that belong to the current year because there are some adjustments to be made with respect to subscription in arrears and in advance. Now, let's say the receipts and payment account shows a total subscription of $8,920, as is the case. We need to check how much of that is for the current year. If there were prepayments for the previous year, in this case $320, then we need to add that to the total. However, if in the current year there are prepayments towards next year, in this case 120, we need to subtract that 120 from the total. Now, on the other hand, accruals or arrears belonging to the previous year, in this case $700, we subtract that amount from the total subscription in the receipts and payment account. Meanwhile, we add any unpaid or accrued subscription that belong to the current year, in this case $920, to the total. So, our adjusted subscription amount for the current year would be $8,920 plus $320 minus $120 minus $700 plus $920, which is equal to $9,340. Of course, we could have simply added the three items on the credit and then simply subtracted the other two. It's much easier. This figure would then be transferred to the income and expenditure account. So let's bear that in mind. We're no longer using that figure here, $8,920 as a subscription figure. We are now using the $9,340, which we calculated. Now, the next accounting record we consider is a trading account, which can be used whenever the organization, though it's a not-for-profit organization, decides to enter into some form of profit-making venture. Of course, the profit from that account or the loss must be transferred to the income and expenditure account. Now let's proceed. Sometimes it may be necessary to calculate the purchases made for a trading activity or event. This can be done by locating the payments made to creditor, suppliers, or accounts payable, their opening and closing balances for the period, and preparing a simple creditor's control account. Briefly, what can be done is to add the year-end or closing balance to the amount paid to suppliers from the receipts and payment account and subtract the opening or year start balance. This will allow the purchase to be formed. Next, all other items relating to that bar fundraising event can be used to prepare a trading account. The profit or the loss from that account must be transferred to the income and expenditure account. Such a profit will be recorded as an income item, while any loss incurred will be recorded as an item of expenditure. It must also be noted that this trading account may be used for any profit-making purpose, including the sale of refreshment, drinks, and so on. Now, in our example, our main source of revenue for the bar was bar takings, which basically refer to the sales from the bar. We had the opening stock of bar supplies, or purchases that we calculated above, add them together and subtract the closing stock to get our cost of goods sold. This cost of goods sold was subtracted from the bar takings to get a gross profit. And from that gross profit, bar expenses was deducted so that you get your overall net profit or your profit from the bar. This profit, however, must be transferred to the income and expenditure account as an income item. Of course, if it was a loss, it will be transferred as an expenditure item. Now, concerning the income and expenditure account, let's take a closer look. Income would typically be found on the receipts and payment accounts debit side, whereas expenditure would typically be found in the receipts and payments on its credit side. Now, expenditure that is recorded in the receipts and payment account can be of two kinds. You can have capital expenditure, that's where you acquire new fixed assets or you add to their value, or you have the monies spent on revenue expenditure, what we normally call expenses. For the purpose of the receipts and payment account, we're interested in revenue expenditure or expenses. Now let's bear in mind, not all the expenses to be recorded in the income and expenditure account would be recorded in the receipts and payment account. Likewise, there are some figures that are recorded here that may need to be adjusted for accruals and prepayment based on the additional information presented in the question. Also be mindful that if fixed assets are given, pay particular attention to the opening and closing balances and compare it with any change that may occur in the receipts and payment account or any item that may potentially cause a change. For example, theater equipment, $70,000 at the start of the year. At the end of the year, it went down to $62,000. Now, one of two things could have occurred. One, there was a sale of theater equipment, which costed $8,000, or there is depreciation. Now, if there is a sale, we typically find the item recorded on the debit side. Of course, you may not see an $8,000 amount. You would see something greater or a little less, depending on how much the item was sold for. But we know $8,000 was removed from the cost of the item. Since there is no record of a sale or purchase or anything relating to that theater equipment, it is evident that the decrease in value of the theater equipment was as a result of depreciation. So, depreciation, $8,000, is recorded as an expenditure item. Similarly, production expenses of $37,600 was paid for by the organization. However, we're told that $4,980 was owing for production expenses at the start of the period, and at the end of the period, $3,080 was also owing. So what would we do? We'd subtract that $4,980 from the amount paid because, of course, we have to settle that bill. And we would add the amount that is still owing for this year to the amount that was paid to find out the full amount of money that should have been recorded for production expenses. That is reflected here. Now, all other items of expenditure are recorded as given in the receipts and payment account. Likewise, all other items of income are recorded. Let's take a look again at the subscription account. We would see $9,340. In addition, donation remained the same, ticket sale remained the same, grants and subsidies remain the same, but there is something else we have here, bar profit. Now that profit was from the trading account that we prepared. We ended with a total of $12,660. That amount of money was transferred to the income section of the income and expenditure account. Now we subtract all of our expenditure, the total, from the total of the income, and we end up with what we would typically call a profit. But we're dealing with a non-trading organization. It is called a surplus, or it can also be referred to as an excess of income over expenditure. Now, having done this, we're at the end of the question. But as a bonus, I've prepared the balance sheet as well. Here you would see the theater equipment valued 70,000 at the start of the year. The depreciation incurred, which was deduced based on the ending value being 62,000. Now we have another fixed asset, motor vehicle. This is recorded in the income and expenditure account. Notice it goes to the balance sheet and it is not recorded in the expenditure section of the income and expenditure account. Motor vehicle is an asset. It's a capital expenditure item, not a revenue expenditure item. So we add these two together to get a net book value. The bar stock, of course, the balance sheet is prepared at the end of the year, so all of these reflect closing balances. So the bar stock figure that is used, the closing balance, the subscription owing of 920. Remember, that's money that's owing to us. So if someone is owing us, if our members are owing us, they are debtors or accounts receivable. That's why we have it included here. It is different from an expense. If it's an expense owing, it means we are owing. That's a liability. The receipts and payment amount, which is your closing balance of 1920. Either you write receipts and payment or you write cash and bank. It makes no difference. You add these three figures together, you get your total for your current assets. Then you list your current liabilities. Your bar suppliers, which would be the same as your accounts payable or your creditors. The closing balance, 3,300. Production expenses owing. As I mentioned earlier, any expense owing is recorded as a liability. And any subscription received in advance from members, meaning they paid us now for a period that is yet to come, it means technically we are owing those persons. We have their money, we did not provide the services yet, so we are owing them. They're like our creditors. That is why we have that 120 here. We add the three figures together, we get 6,500, which we would subtract from the total of the current assets, give us $1,000 for our working capital or our net current assets. And we take that 1,000 and add it together with the 92,200 from the fixed asset net book value, give us a total of $93,200. Now, our accumulated fund at the start of the period was $70,380, and our our surplus was $22,820. So we add these two figures together, give us a total of $93,200. This takes us to the end of the question. Thank you very much for viewing. See you again soon.